So, hello everyone, and thanks for taking the time and being here today in our third webinar related to the UBS Quant Hackathon 2020. So this webinar, like the previous two webinars, will be available on our Alphien channel on YouTube and on Alphien platform right after the end of the presentation. So please don't hesitate to share the link with your teammates if they could not attend this event. So let's get started. So this webinar will be a bit different from the first two webinars. First, because this time we will focus on the second competition, which is the machine learning for complex pricing model. But first, we would like to share with you a bit of statistics. So you can see here that the most represented university participating in the competition. And the next slide, you can see as well, since the winner will be selected by region. So you can see as well the participation by region, Asia Pacific, Europe, and America. And on the right side, you can see as well how the student created and composed their team since it was between 2 members and 5 members. So secondly, we have today 2 presenters from UBS, which is the sponsor of the competition. So the first presenter will be Vinay Srinivas, head of quant analytics and digital transformation in Asia Pacific. He has been working for 12 years for UBS and is currently based in Hong Kong. So he will talk on the quant setup in the UBS investment bank in various departments, how quants contribute front to back in various initiatives, and as well on the structured products market, which is part of this second competition. And the second presenter will be Alexandre Cohen. He has been as well working about 10 years for UBS and is also based in Hong Kong. So we will present the equity derivatives quant team in Asia Pacific, the models for path-dependent products, and it will end up with non-parametric modeling for fast quotation, which is really the prime behind the second competition of this UBS Quant Hackathon 2020. So, this current presentation is done on the Alphien platform. So there will be a Q&A session at the end of the presentation. So please ask a question on YouTube. We will group your question during the session, during the webinar. So during the webinar, if we don't have answer your question during the webinar, please go to Alphien website and ask your question on the forum. We will prompt to answer them. So no further ado, I'm gonna pass.
Thanks, Philip.
Yeah, then I'm going to pass to Vinay.
Hey, thanks, Philip. So everybody, welcome to the webinar. Just excuse us both for Alex and me. It's one of the first times that we're doing this kind of webinar face-to-face, but we are very excited about this competition. So the Quant Hackathon itself is we're very excited about this because we get to interact with strong talents like you. And often the question that comes out is, what do the quants really do in a bank? Well, why are we having this? So and the quant name itself has become very kind of widespread now. Quant could be I'll come to different types of quants, but there could be a modeling quant, there could be a data scientist is also a quant, there could be a quant trader, there could be a quantitative salesperson. So in effect, what's happening is, as and when the banks are evolving, and they're evolving very fast, even though it doesn't show very much externally, the banks are evolving very fast because of just the FinTech environment that's actually coming through. The way things are evolving, it's happening a lot faster than you actually see from externally. So quants are central to investment banks. Quants are involved front to back in algorithms for trade executions, trading strategies, models for pricing and risk management of financial products, settlements, and counterparty risks. So when I started my career, as Philip mentioned, 12, 13 years back, before that, I was also in a bank. I was working in technology. Since then, things have worked quite differently. Things have evolving really in an exponential basis now. So what we see now is that any technology that comes in, it's just because the banks have a lot of spend on the technology side of things. For example, a typical investment bank could be spending as much as $3.5 billion US dollars annually in their technology. So when we say technology and when we say quants, it's all kind of intertwined. The main reason is that without, at least especially in the investment banking, and when I say investment banking, there's two components in there. There's the market side, and there's also the banking, the M&A and IPO and other things. But on the market side, it's very competitive for the quantitative talent, because it's just the way that we evolved, the number of departments that we have, the number of products that we have, the financial products that we have, the number of optimizations that we need to do, the number of client interactions that we do, and how we expand our wallet, how we expand our margin, actually margins are really compressing. So how do we actually make it more efficient? That's where all the quant work really comes into picture. So I'll just briefly go through different kind of setup that typical investment bank would have, and probably this is a lot more true for UBS. In the markets world, you have usually have the electronic trading side of things. Then you have the where you actually go and build a lot of the quants go and build a lot of algos. Like it could be a VWAP or a TWAP or execution algos, where you say, I want to get the best execution for the clients given some constraints. So you come up with products and you try to say, okay, how is it actually? Then you also need to say, okay, how did the market execution happen? So that's the first area where actually there's a lot of things that, and then when you actually see, okay, for example, in the US, there's multiple venues for the same stock to be trading. How do you optimize which exchange it goes to? Where do you actually go and say the market impact that comes because of your execution? How do you reduce that? Or how do you actually not be on the wrong side of the execution? Do you go and buy on the bid or the offer? How do you do that? Where do you wait? What kind of risk do you carry not doing the execution immediately? So there's a lot of constraints and conditions that go into that, and that this needs a lot of quantitative skills. You also need to, for building any of your models, obviously you need to go and build a lot of historical data as well. And this is where you collect every tick, every order book change that actually happens in the electronic world, and you try to build models on top of that. So that's the first area. The second area is the derivatives area. And this is where you come up with a lot of financial products. You can also have low latency trading systems there, where you actually go and try market making for listed options, or you could be market making for the warrants, for example. There's a lot of products to be done. You could be market making for bonds. You could be market making for credit derivatives. There's a whole lot of gamut of things that we could be doing. That is, again, very quant and tech focused. And this is, again, similar things to as the execution and the electronic execution side of things. You need to have a lot of historical data to try and build your models. Even though the models would be a mixed here now, you'll be doing the execution models. You also would be doing pricing models. How does my volatility move if my spot, my underlying asset price moves? What does it happen when the option is out of money? What does it happen when option is in the money? How does it move? Intraday, how is it moving? How do we go and look at our volatility through the day? So these all comes in part of the derivatives world. Apart from the market making activity that I mentioned, there's also going to be there's a lot of financial products that come in. So you can say, are there any? We're going to cover structured products in detail later on, but how can you enhance the yield for the end customers? For example, because of all the COVID-19 situation, all the interest rates are at all-time low levels now. But how do you actually, if somebody has some money to invest, how do you actually tailor a product so that they can get slightly better interest or the yield on their products, on their money? So there's different kinds of products that you can go and tailor that. So structured products is a bit of a mass product, but there's also other products that you can be coming up with. You can say there's something called quantitative investment strategies, which I guess Alphien has covered in detail, but there's also what kind of strategies can you come up with? How can you actually rotate a portfolio of your strategies? There's something called risk premium. How do you create smart beta products? How do you actually rotate them? So there's a lot of different things that's actually happened in the derivative space as well. Again, what happens in the derivative space is also these derivatives are also, they take some of the balance sheet. So what do you need to do on the balance sheet side of things? How do you optimize your balance sheet? It all seems like balance sheet is a very accounting kind of problem, but in reality, there's a lot of quantitative analysis that needs to be used for that. There's a lot of different kinds of analytics that you need to use to go and see, okay, how do I actually, for a given set of risk, how can I optimize my returns on that? So that's the derivatives area. And the third area that all the investment banks tend to have is the prime financing or prime brokerage in some areas, or financing area, where you actually provide financing to the clients, where you say these are the things that we need to be doing for clients. How do we actually provide balance sheet to them so that they will be able to leverage their own balance sheet with us to get more returns? What kind of services do we provide them? So there it actually becomes very important when what we call is the resources. For a given client, how much is their utilization of the balance sheet? How much of their returns are they getting there? How can we help them? What kind of risk do they have on their side? Then on the same side, you also need to say, okay, you've got so much inventory sitting with you from the inventory that the clients brought in, from stocks, the bonds, the repo, and everything. How do you go and optimize that? How do we actually manage the inventory? What kind of funding we should be charging on that? So there's again a entirely different set of quant skills required there, and this is again very evolving area, and this is a very again, as I mentioned earlier, these margins are compressing. So the more smarter that you are, the better you are. If you have something, the bonds and stocks sitting with you, how do you use that as a collateral? So all these areas, everywhere, it's the quants that's required. And again, there's no kind of distinction between quants, quant traders, strategists in some banks. Quants are involved front to back everywhere. And again, all the three pillars that we discussed and the global markets area, everything's very, very data intensive, very analytics intensive. The fourth pillar that we have, and this is the research area. Traditionally, research included a lot of people going and doing interviews and writing about companies with fundamental views and things like that. But now, as you might know, this has evolved quite a bit as well. Now you actually go and collect data from satellites, alternative data sets, and you try to build some models and say, okay, this is what we think is going to be happening in the market. This is what we think is going to be happening there's a macro view in each of the countries that's going to happen, what's going to happen to the companies as well. Again, that's the fourth area as well. There's a lot of quantitative analytics involved, or the quantitative skills involved. So when we were designing these competitions, we were actually thinking about various things. So the first competition that you heard about, that was more in terms of the investment strategies. So how do you go and outperform the S&P 500? But the second one, that's more in the investment strategy space. The second one we are looking at is the modeling side. So the modeling side, again, the problem is there's never a textbook model that you can actually go and say, okay, I'm going to go and implement that, and this is always going to solve our problem. You are trying to model a market that's evolving rapidly. You are modeling a market that's actually very prone to changes in the social situation, prone to changes due to the economic situation. There's all those things. It's not just you can think about just as a single line. When I was talking about electronic execution and derivatives, they're all kind of interlinked as well. Sometimes you see depending on what things are happening in the option market, it could be affecting what's happening in the stock market as well. So there's a lot of things that needs to be considered, and it's just the way you visualize this, where you understand this, where you model this. That's the differentiator for all the banks. That's why there's a bit of competition amongst the banks to get this kind of technology, this kind of analytics built into that. And just on that, so I'm repeating the same thing, but the big data, machine learning, and AI into day-to-day problem solving is critical. Without that, we cannot evolve as fast as we want to be. And the quants are the people participating in this hackathon being our best place to apply this data science techniques, because in some way you have both mathematics skills and the system skills. And this is where UBS is in the forefront of FinTech revolution in Asia, Europe, and US as well. So there's a lot of things we are doing, which is probably not as apparent from what you've seen in news, because quite a few of these things are done internally and not publicized as extensively. So that's that's what I wanted to cover in the quant setup and what all quants do. And then the other area that we was going to. So I think if you've got any questions on this, I think we can leave it for later, and we can actually tackle it from there. The other areas that we were going to cover was the what kind of
or maybe Vinay, I can just ask a question. Thing is, where do you think, you guys talking about quantitative strategy, where do you think is going to be more and more important in the futures versus fundamental trading?
Yes. Okay, that's a very good question. Thanks, Billy. So the main idea with the quantitative investment strategies is that you have calibrated your risk very well on this. So when it happens to the fundamental trading, it's really, you're looking at the balance sheets of the company and doing all the calculations and say, okay, this is a long-term holding that we want to do. And the rotation of your investments in there is probably not as scientific. There's still an element of human thinking that's going into there. So there's still a if and when and how, all those things are still there. But what we do in the investment strategies world is all more signal based, and these are tried and tested signals that you can actually say, okay, this is my risk premium going on there. This is my risk factor that I see in there, and this is what I actually see. Okay, these are the signals that's coming out of that. There's a lot of data and testing that's been done on this, and what we have seen is the main thing that people try to do is that you actually go through different market regimes. Everybody talks about 2007 financial crisis. Now people are including on also the March, April COVID-19 related market shocks that we have. So the advantage with this is you get a rotation of strategies as well. So you can have a strategy of strategies. So there you can actually say, we assure you, these are there's a lot of different techniques to put on that. This is the target that we can return, that we can give you. and the whole strategy itself will have so much of volatility as a cap. So there's different constraints you can place as well. So you can actually tailor make this to your investment needs. And that's where it becomes a bit of an open problem as well. Not just as you can just go and solve as a fundamental thing. I think this is good. I'll go and invest in that. And that's why I think this is one of the very interesting parts of things. And this is becoming more and more widespread. A lot of institutions, bigger institutions, are getting into that. It's only a matter of time when these investment strategies are packaged into smaller products, and you can actually start selling it to retail clients. So it's only going to grow bigger and bigger. It's also good for the clients and also the investment, because it's all very formulaic. The risk that you carry, the shocks that you can get from the markets is actually limited. You've actually tested it all. So I think that's and it's also the outperformance and the different indices on the general market is also well documented. So there would be things like crowding and other things happening, people getting into the same strategy, causing markets to shift a little bit. But in spite of that, these are the kind of strategies that will actually be the long-term cornerstone for big institutions and eventually to the retail people as well.
Okay, thanks, Vinay.
So that was the other area that I was going to cover was so we covered how quants are set up, or how the departments are set up in markets area, and we also covered the research area, and then we said, okay, how quants contribute to front to back in various initiatives. What I didn't cover actually as across the departments was that you also need to go and see what's what we call the resources. What is the credit risk of all the portfolio that we have traded with our clients? What is the likely biggest loss that we can actually have if the market tanks or market goes other way? How do we actually risk manage these? So for risk management alone, you can actually have risk management on an individual trading desk level, but that's a kind of a micro risk management. But you also need to have on the firm level that things move so much, equities move so much, the bonds move so much, the credit derivatives move so much. Overall, how are we managing the risk as a big portfolio? And this is where there's a lot of risk quants involved as well, risk strategies involved as well, and where we actually say, okay, this is we need to build a lot of models in there. Again, VAR, or value at risk, is a common one, but that's also evolving really fast. There's, again, credit risk. How do you say what is happening in the counterparty risk that the banks own? So there's various areas, front to back, everywhere. So you start from okay, what is the best price to quote? Then once you quote, how do you best price to quote to include all our hedging costs? What's the best price to get the trade? So that includes our risk management costs. Once you get the trade, how do you actually risk manage it through different market regimes? And then you also need to say, okay, what is the best utilization of the inventory that's come through? How do you settle it best? And then you also need to look at the counterparty risk. You also need to look at the market risk. And you also need to see how much of resources we are using. So all these things is front to back, everywhere the quants are involved. So the last topic that I wanted to cover, so I think I've gone over time, is structured products market. So traditionally, again, as I was suggesting earlier, structured products is a way, at least in Asia and Europe, this is pretty big because there's a lot of private banks. Even private banks need to offer yield-enhancing products to their clients. And when you cannot do it without a bit of an alchemy, so what you need to do is you need to be mixing options and bonds and things like that to come up with a higher yield, so that the client can get a better return on their investment. So that's where all the structured products come in. So you could be, I'll just say a few names so that just people can carry that. There's something called an accumulator, for example, where you actually say, okay, if the you have a strike price on that, if the stock price is above a strike, you get so many shares. You accrue so many shares. It could be double some leverage there or no leverage there, or you could have a knockout on this structure as well. We say as soon as it goes above a certain level, the trade stops to exist. So that's called an auto call. Or sometimes the client could actually say, I'm going to call this. So this callable products as well. Or sometimes the bank can say, I'm going to stop this product. So there's a lot of combinations of these features that you can put together. The basic design behind all those things is that you need to have a model behind it. There's a cost of providing an option to somebody, or there's either you're buying or selling. You need to price those things. But the main thing is you need to start putting all these things together to tailor a financial product that gives that. So this product has been very interesting. It's a major product for a lot of private banks and catering to their high net worth clients or even medium net worth clients. And this is where it's also gone retail. Some of the retail banks also go and sell it to their retail clients as well. So the idea is that accumulator was one example. There's also other things that you can have various features. So as a quant, what you get to see is that you are combining different products or different features of a product, and you say, okay, what is the impact of that happening? Or how do I go and combine that to give a better returns? Or we know this is a high dividend yielding stock, or this is it's a tech stock, it's a high volatility stock. How do we combine that, building into taking the small building blocks and give a structured product? And that's the part that the structuring quants do, the structurings or the strategists do that. This again a very interesting way that banks rely on. So and again, to understand these products and risk manage, you need this quant talent again. That's the structured products trading team that actually does that, apart from the market making teams that I mentioned earlier. So there's various areas that this structured products business is fairly pervasive. It's a big flow. This also gives you kind of access as well for somebody in say Japan wants to go and have exposure to some of the tech stocks in US. They can actually do through structured products, because they can actually go out and buy a product that says something with stock A, B, C from US. Some of the tech stocks, I'm not going to name them. They can say, okay, I'm going to buy some structured products based on the performance of the FANG stocks, for example. I can get this much returns. So you can actually start tailoring this. So this also opens up it becomes an access product as well. So that's where the structured products become really important. At that point, I'll close it. Yeah, thanks.
Thanks, Vinay. So yeah, you mentioned about accumulator, and I know it's very popular. I mean, structured product, especially as well in Hong Kong. So I know as well, Alex wants to talk a bit about the path-dependent model, and accumulator is one of them. So maybe as well, Alex, is a bit time for you to talk about the topic you want to mention today. Thanks, Vinay, again for your speech. So, Alex, is your turn.
Sure. Hello, everybody, and thank you again for participating in this competition, especially on the machine learning one, which is quite important to us and to me. So here I would like to talk about 3 different topics. So first I will explain very quickly how the quant team is set up in APAC, especially on the equity derivatives part. As you can imagine, with all the sort of quants that exist at UBS that Vinay mentioned, there are dozens, of quants based in Asia. On the equity derivatives part, globally, UBS has around maybe 30 people, and there is a team of 10 is based in APAC, mostly spread across Shanghai and Hong Kong. Our focus is on models and technology for derivatives pricing, and especially here we have also quite a strong focus on stochastic volatility modeling. You will understand why it's important for some of the derivatives products that Vinay alluded to. Actually, stochastic volatility modeling, we got awarded our team in Asia Quant House of the Year in 2018 and 2020 for projects that relates to it. Actually, if you look on the internet on Risk Magazine, you will see that the 2020 project is quite related to the competition you are working on at the moment, if you have not seen already. Second component that I wanted to talk to is derivatives pricing, just so that you get a bit of context about how we got to the non-parametric modeling that we asked you to think about. So derivative pricing, I think you can decompose it roughly into two classes, payoffs that we classify as terminal payoff. For example, the typical European options, vanilla calls and put options. It gives the right to the buyer to buy or sell a stock at a predefined time that people call expiry, let's say in 1 year, at a level that is decided today. And you can see from the definition of this payoff is that the payoff depends only on the value of the stock in 1 year. So you can imagine that models that are required to price such payoffs, they just need to get right the probability distribution of the stock in 1 year. It does not depend at all how the stock achieved its value in 1 year. What matters is what is its value in 1 year. The stock could have gone up, down, always down. What matters is what is the value at expiry. And then there is a more complex class of payoff that we call path-dependent payoff, as opposed to terminal payoff. And here there are payoff where it's not only the value of the stock at a given point in time that matters, both for the payoff and therefore for the price of the product. It depends on various features of the trajectory of the stock price. A simple one can be an Asian call or put option. So instead of having the right to buy or sell the stock at a given value in 1 year, it will be at a value that depends on the average value of the spot from now until 1 year. So you can see it does not depend so much whether it's going up or down, but the average value of the stock matters. So it's not only at expiry that the stock price matters here. And then you have also payoff where it's the direction of the move of the stock during its life that matters. A simple one can be a daily discrete barrier options. You can imagine that you have a level that is called the barrier, and then you will get something in 1 year only if the stock never crossed that barrier. For example, if you have an up barrier, then you can say, okay, you will get something in 1 year only if the stock remain below that barrier every day. And then you can see that this payoff suddenly becomes dependent on what the spot is equal to every day, and the models that are required to price this, the basic stuff that you need to ask for them is that the probability of the stock at every time horizon between now and expiry is consistent with how the market views it today. So the simplest model for that is called the local volatility model. It has been introduced by Dupier many years ago. It's a model that will be consistent with the stock distribution for every point in time from now until the expiry of the trade. But you can also see in the examples that I said that it also depends on future conditional distribution of the spot. For example, you can imagine easily that this product depends on what is the probability that the spot is going to be above the barrier tomorrow, given it was below the barrier today, for example. And this is a more complex class of probability distribution that you want the model to be flexible on, and the local volatility model does not have enough flexibility to allow you to play on this kind of distributions. So this is where more complex model like stochastic volatility model enter into play, because with these models, not only you can be consistent with what we call the terminal distribution of the underlyings, but also the conditional future distribution of the underlyings. And you can make them, you can set up the, let's say, the volatility of the volatility in this model, the correlation between the spot and the volatility, such that you fit a given market of complex payoffs. You can also imagine that if the payoff has a very long dated expiry, you are not sure what the rates will be when you want to discount the premium, or if the payoff depends directly on the rate, so it could also be depending on the stochastic rates models. So in banks, like most banks, they have the GPR local volatility model implemented, used for risk management in their production system. Most banks are like that. Where there is a bit less banks that are able to do it is with a stochastic volatility model. They are much slower model. It's not always easy to implement them for risk management in a risk management system. And even when they are implemented and used, there is still the quoting problem of structured product. As Vinay was saying, the example of a client based in Japan who wants to do structured product, we have thousands of quotes like that, quote requests that comes to UBS every day, and we need to answer quickly the clients with a price. And while you could afford to risk manage your derivatives product, i.e. the product that you have really traded with some clients using a stochastic volatility model or stochastic rate model, jump model, any kind of model, in quoting, it's a much more complex problem because you need to be very fast. And here what banks tend to do is they quote in a local volatility model, and then they charge a fixed premium on top of their local volatility price to account for the fact that they know that the local volatility model could underprice some of the structured products they are quoting. And this way they are fast enough, and still they try to be conservative, acknowledging the limitation of the local volatility model. So this is good for speed, but you can imagine that because it can be a fixed charge that is not completely tailored to the market situation and to the product configuration, sometimes this fixed charge can be too expensive, in which case maybe you are missing some trade because you are charging too much to the client to do this trade, or too cheap, in which case maybe you do a lot of trade, but actually you end up losing money risk managing this product because you have not brought with you enough money to pay for the risk management of the product on your side. So ideal situation will be to quote using directly these complex models, but if they are too slow, or if other market participants don't do the same thing, you will appear as someone that quote very slow. Even if you quote accurate, you quote too slow, and you might end up losing some trades also by being too slow versus other banks. So what we have been trying to do is, can we achieve a very good quoting speed with complex models? And to do that, we asked ourselves the question, can we build non-parametric models, so machine learning kind of models that can instantly give you the price of the complex model given a market data situation and a payoff that you are trying to price. So this, if you think about it, is extremely complex. It depends on many factors. And we quickly eliminated that idea to a much more realistic one, which is trying to build a model that will learn the difference between a base model, let's say the local volatility model that already takes into account a lot of factors in its value, and the more complex model. The difference between the two intuitively should depend on much less factor, and it's much more realistic to train a model on it. So that's basically the competition that we organized here. We created a lot of market data scenarios, and for each market data scenario, a lot of possible configuration of contractual inputs for a complex structured product. And then so this becomes basically your big matrix X in a typical machine learning product with all the possible features. And then the target is the true difference that we computed using the true local volatility model and the true more complex model that we want to use here. And this difference between the target that we want to learn using a machine learning model. Then at quoting time, what happens is that you would quote using the local volatility model, and then you call your machine learning model that in a fraction of a second is supposed to give you what is the actual charge that you want to add for this market data and this contract to get the fully embedded price that can take into account various effects, jump, stochastic rate, stochastic volatility, any kind of things basically. So that's how this competition is based on basically. And one, I think of the questions that you might have asked yourself that maybe is more obvious now. I think you might wonder why for this kind of model, we are not just interested in the root mean square of error, like in typical approximation of models. We are also very much interested in the maximum absolute error, because if we have a model that is okay most of the time, but in some cases can return completely crazy prices, that's also very bad. If the crazy price is way too expensive, very rarely, okay, maybe very rarely, we might end up losing some trade. If it's actually way too cheap, it's quite dangerous for us because we will lose money on risk management. So that's also why the maximum absolute error was also very important for this kind of model. So it's quite an innovation, I think, in the quant space. I think all of us across banks, we are at the very beginning of seeing how to incorporate machine learning into pricing. It's a very complex problem. We have found a solution for it. Actually, the competition is trying to see if you have other ideas than us to build this model. Maybe you will find a better model, give us ideas. So this competition is very important for us because depending on the outcome can really be something that will help UBS as a whole. Like if you find a very good algorithm that is actually better than our algorithm, that's all the best for us as well.
So yeah, Alex, yeah, if I just you just mentioned just a sum up as well. You mentioned I mean UBS cared about overvalue or undervalue the quotation, so that's why you really care the most is about maximum absolute error, right?
Yes, correct.
Yes. Okay.
Because you want to be accurate in quoting, basically. It's not a problem. It's a problem where I want to know if I get a price, I know that it is off by max X bips, for example, and not that there is a 1% probability that it's off by 10%.
Okay. We have one question as well from people on YouTube is why is a stochastic volatility model slower than a local vol?
So very roughly, and we can enter into the details, but you can imagine that when you compute a structured product, you basically compute Monte Carlo methods for it. So you simulate spot trajectories. In a stochastic volatility model, you also need to simulate the volatility of each stock. Not just the stock, but also the volatility of each stock. So you can imagine, roughly speaking, that it should be twice slower than a non-stochastic volatility model. Actually, you can enter in the details. The GPR local vol model is somehow a stochastic volatility model because the volatility depends on the stock level, but a true stochastic volatility model, let's say, depends on an extra factor than the spot level, and you need to simulate that extra factor. So you have twice the number of things to simulate in a stochastic vol model, roughly speaking.
Okay, and I think as well, accumulator as well as path dependent, so you are usually
yes, so accumulator is also another kind of path-dependent product where there will be indeed a stochastic volatility effect on top of a local volatility, various effects as well.
Okay.
I don't know if there is any other questions on this competition or this particular topic, or even some more broad question about the equity derivatives quants.
So what are the structured products were really, you are based in Hong Kong. What are the structured products are really popular, in Asia Pacific in general? And
there is definitely the accumulators, as you said, there is
Europe as well. Sorry, and if the market, is it different from Europe or US? Is it?
But there is accumulators a bit in each market. We have also a very huge class of products that is called autocallables. They are very complex barrier-based product with multiple levels of monitoring, multiple barriers. They are also in each regions. Maybe in the US, what people would have more compared to a region like Europe is autocallable on stocks versus as opposed to autocallable on indices. Maybe that's the underlying that are a bit different depending on the market. Maybe shorter expiries in the US sometimes than in Europe or APAC. But this kind of products, they exist in all markets. So this kind of competition is useful globally to UBS, and this kind of topic is useful globally to UBS because the logic applied here can be reused in many payoffs and many kind of underlying. That's also what makes it difficult, is that the market data features that you need to engineer, they need to work for almost any kind of underlyings that people might want to trade.
So we have another question as well is, how does machine learning improve risk management? Because, okay, you are talking about the this machine learning using for quotation. So I guess the participant would like to know, probably, are you using it as well in risk management? And
so machine learning for risk management, it's let's say another step. For example, for quoting, what you care about is the price. For risk management, you care about the Greeks, so the sensitivity of the price with respect to various market observable, for example, the volatility, the spot. So you could imagine that if you have a good enough machine learning model, it can tell you what should be the price when you bump the volatility up and down to compute your Vega, and then you compute the difference. A typical finite difference algorithm will give you the delta. That said, in that case, it will be a more complex problem for people to solve because you want the price returned by the ML model to be smooth with respect to every feature that goes in the model. Otherwise, if it's not smooth and the price can jump with a small perturbation of an input, then you will get extremely noisy Greeks, and it's completely unusable for risk management. So that's one additional component to take into account. For this competition, we didn't want to create something so complex, and we were just focusing on the pricing aspect of it. Also, for risk management is a bit less of a concern for quoting because you don't have to reply within a few seconds to a client with a quote. Like you have your huge farm of computers that compute the risk, and within a few minutes or hours, depending on the risks, and you get your results. So the time constraint is a bit less critical than on quoting.
Okay, thanks, Alex. Maybe 1 minute to conclude. After that, I'm going to pass to Vinay to conclude the webinar. Sure. If you maybe want to say something to the students and for this competition, I don't know if you have.
Yeah. So for this one, as I said, this one we designed the topic to be very useful for us and of practical use. As I said, I wouldn't be surprised that one of the students' team or many teams, like who knows now a lot on machine learning through their studies, might have a different view than us and produce a model that competes with ours, might be even better. We might learn from it, and we might use the ideas later. So that's why this topic is, I find it very good for us because there is really a practical use after that. We can learn from it basically and can be used afterwards.
So okay, yeah. Thanks. And even if we have 350 teams registered for the competition and 250 teams registered for this specific competition. So okay. Hopefully we'll get some.
Yeah, hopefully.
Yeah. So
your turn.
Sorry. Thanks, Philip. Thanks, Alex. So the one thing that we really want to emphasize is this. Again, these are some of the kind of projects that's actually going on as a quant thing, and as I said, UBS on its own is actually trying to become as quantitative and digital as possible. So one request for all the participants here is please go and register yourself on the link there, the link on the Alphien platform, and there's also an email that was sent through Alphien that will that will really allow us to talk to you and try to have a conversation about what kind of careers as well that you would be interested, and this especially in banks. What can you be doing? What kind of interest that you have? How can we align that? So that is really, it's not just about, I mean, it's also the competition, which is really the key part, but it's also how we can actually help you otherwise as well in building your careers.
Yeah, we have a question on this, Vinay. What are the key things you are looking for when hiring a quant?
Okay, I was going to joke something, but I'm not going to do that. So I think the key things that it's the ability to, as most of the quants, it's not going to be, you don't get a question and you go and solve it directly. It's just like the problem that Alex was mentioning, that, okay, you can do everything with the Black-Scholes plus this and that and everything, but there's always a better solution. How do you think outside? How do you actually try to make a problem, simplify the problem, and how do you actually solve it? How do you, that's the area that the skill set that you're looking at. So usually it's a good mathematical background and a good technical skill set, and the ability to think outside of the general, I'm not going to say think out of the box, but think in a bigger way, and how we can actually impact your projects is the main thing that we really look at.
Thanks, Vinay. So I think we're going to close this webinar. Thank you very much for your participation. And I hope the best of the student. I hope they learn a lot for doing this webinar. Thanks to both of you.
Thank you very much.
Thank you. I think there's a lot happening, so definitely encourage people to register and also to reach out to us if there's any questions. There's a lot to learn here. Thank you.
Thank you. Thanks, Vinay. Thanks, Alex.
Thank you. Bye-bye.